So is there really such thing as a no-cost refinance? Well, there's no such thing as a free lunch, and in the same vein, there's really no such thing as a no-cost refinance. Do you have to bring cash to the closing table on a refinance? Not necessarily. In fact, in most cases, borrowers do not bring money to the table, but it doesn't mean that you're not paying for it one way or the other. So on a refinance, just like on a purchase transaction, you have closing costs. And if you're escrowing taxes and insurance, you also have prepaids and escrows. Taxes, insurance, and interest that's paid at the closing table, but is more related to expenses going forward with the property. So whether or not you pay cash at the closing table for these expenses, or you finance them, or they get priced into the loan, you are paying for them. There is no such thing as a refinance that doesn't have these costs. It's just a matter of how the bank pays for them or how they charge you for them, but you will pay them one way or another. So the most typical way that you will pay for closing costs, prepaids, and escrows on your refinance is it simply gets added to the loan amount. So when we go to refinance your mortgage, we have to pay off that underlying mortgage, the mortgage that you still are making payments on, the mortgage that still has a lien on your property. So the balance, the outstanding principal balance gets paid off, plus any interest that is accrued since from your last payment to the date of actually executing the refinance, plus closing costs, prepaids, and escrows. All that amount simply gets added to the loan amount. So your new loan will be more than the principal balance that your mortgage is right now. You could pay cash for your closing costs, prepaids, and escrows. This is probably the most efficient way to do it in terms of maximizing your savings on your refinance. The problem is, unlike a purchase transaction where people are planning and saving towards this big purchase, usually a refinance kind of sneaks up on you. You get a call from someone like me and says, hey, rates have dropped by this much. This is how much I can save you every single month. And all of a sudden you're thinking, well, now's the time to refinance. But I haven't pocketed away $6,000 or $12,000 that I can just write a check for. So usually that kind of catches us by surprise. The other way to do it, and this is generally where, some sort of purists that I talk to get the impression that there is a way to do a no-cost refinance, right? The loan amount isn't getting increased and I'm not writing a check at the closing table, so it's no cost, right? No. What the bank is doing is they're simply not giving you the lowest rate that they can. Let's say that they can lower your interest rate to 5.25%. What they'll do instead is reduce it to maybe 5.5% or 5.625%. Then they've created a margin in between 5% and 5.5 or 5.625%. And they use this margin, which generates a lender credit, to pay for those closing costs, prepaids, and escrows. Now, some people may say, well, that's kind of sneaky. That's bad. I'm not getting the lowest interest rate possible. Well, it may not be that bad of an idea. It all depends on how much you have to increase the interest rate by in order to generate a sufficient credit to cover those costs. If you had to increase the interest rate by 0.5%, it almost certainly would not be worth it. But let's take a look real quick at how that actually breaks down. What are the monthly savings if you increase the loan amount versus increasing the interest rate? And maybe it's not the best way to think of it, of increasing the interest rate, but rather when you refinance, you're just simply not lowering it as much as you otherwise could. Let's take a look at the numbers. So here we have 4 different refinance scenarios, and we are refinancing a mortgage that is about 20 months old, right? 21 months old. There have been 19 mortgage payments on it, and that balance has gone down to about $440,000 from a starting balance of $450,000. Okay. Then you'll notice, that interest rate was a 6.5% interest rate. The 4 refinance scenarios start at 5.25 and are increasing by 1/8 each time. The first refinance scenario here
is as if we are financing the closing costs, prepaids, and escrows. That is why the loan amount is increasing from the current balance of 440,522 to about 448, right? So there's about $8,000 worth of closing costs, $7,500 worth of closing costs that we are adding into the loan amount. That's why the loan amount has increased. And on a refinance, you'd also be paying some unpaid interest, but to keep it simple, we're not adding that in on this refinance. So what these scenarios are showing is that, in any of these scenarios, you're going to be saving money, right? You're going to be improving your cash flow and saving interest. If you are financing your closing costs, prepaids and escrows, and increasing your loan amount to 448, you are not achieving quite the most monthly savings, right? You're reducing your monthly payment by $370 versus this scenario here where you're reducing it by $377, okay? But remember, the purpose of the refinance is not necessarily or is not singularly to improve your cash flow or to reduce your monthly payment. The real goal should be to reduce your interest spent over time. That's why we can see down here that adding the closing costs, prepaids, and escrows to the loan amount, financing them is the best option. So, but let's take a close look at this option here, right? This is where you are increasing the interest rate to 5.375 to generate a credit to pay for your costs, okay? So you are increasing it by 1/8 over the 5.25, and we're assuming the 5.25 is the best interest rate you can get without having to pay points. So again, you're getting the best monthly payment improvement by doing it this way because you're keeping the loan amount low, right? Your savings are actually, for all intents and purposes, they're identical to a scenario where you're taking the lowest interest rate and adding the closing costs, prepaids, and escrows to the loan amount. But here's the problem with this scenario. This scenario right here is almost certainly not going to be an option. You would have to have a very, very large loan amount in order to generate a sufficient lender credit to cover all your closing costs, prepaids, and escrows, right? Remember, in this scenario, we need about $8,000 to cover all our costs. It's unlikely that a small 1/8 increase in your interest rate is going to generate $8,000 to cover those costs. So while that seems like a great option, it's probably not realistic. So when we look at the other two options, maybe I will say they're more realistic, interest rates that could potentially generate those costs. Then you look at the monthly payment. The monthly payment is not, you're not improving the monthly payment nearly as much, right? It's $30 and $40 of a less of an improvement. And then the big one, your savings over 12 months, savings over your next 12 mortgage payments. Look, you're not saving nearly as much money, right? The financing option is $700 more efficient over the course of 12 months than it is if you have to increase the interest rate by 5.5. So already, assuming a 5.5% interest rate or a 0.25% higher interest rate would be more efficient, right? 5.25 to 5.5, or assuming that was what was needed to yield enough of a credit, it's not giving you the most savings. And when you go down here and you look at your total interest spent over the course of 3 years, so this category here, this is showing you your savings over 12 months. And this is kind of the inverse. It's showing you how much you're spending over, but in the time period is 3 years. This is the best option, right? You have more savings over that same period of time. Now you could say, well, this one is going to be the better option because it is only it's keeping my loan amount a little bit lower, right? But keep in mind, again, that 5.375 and likely even the 5.5 are not going to be big enough to generate the credit that you would actually need.
So that seems fairly clear that usually the best approach is going to be to simply finance the closing costs, prepaids, and escrows. add them to the loan amount. Now, if we're able to do this, sometimes that may not be an option. If the balance of your new loan is going to be more than 95% of its current value, then we may actually not be able to increase the loan amount anymore. And maybe you do bring a little bit of cash to the closing table, or maybe we just raise the rate an eighth, and that generates enough of a credit that we can use to pay off some of those expenses. The way I like to do refinances, and again, there's no right or wrong way to pay for these costs, but the way I like to do it is to finance the closing costs, all right? Finance the costs that are actually associated with the transaction. In other words, if you didn't refinance, you wouldn't incur these costs. An origination fee, an appraisal inspection fee if you need one on a refinance, the attorney's fee, title insurance, recording fees. And then write a check for the prepaids and escrows. Remember, prepaids and escrows are not an actual cost of refinancing because you won't spend any more on taxes and insurance by virtue of refinancing. We're saving for the same exact tax bill and the same exact insurance premium that your current servicer is saving for. Now, we still have to collect them, but we're not going to spend any more. So the other thing is, if you're currently escrowing taxes and insurance, about 25 days after closing, your current servicer must return your escrow balance back to you in its entirety. The way that works is we will collect at closing enough insurance and enough taxes so that when those two bills come around, whenever that may be, we have enough money in the escrow account to pay for them. So if we're preparing for the same bills, the way it works out is your current servicer probably has about 80% of the taxes and insurance already saved for you that we're about to collect from you. So if you can pay cash for your escrows and prepaids on a refinance, you're going to be sort of reimbursed for the majority of that expense within about 25 days of closing. So what this does is it keeps your cash to close low. You're only going to be paying cash to close for prepaids and escrows, right? Taxes and insurance, so that you're not kind of caught off guard and not writing a check for $8,000 or $12,000. And then it also helps keep the loan amount a little bit lower so that we maximize the amount of monthly savings you have in the refinance. So in conclusion, if you hear someone say that they got a no-cost refinance, that's not exactly how it works. You're always going to be charged for these things. It's just a matter of how you pay for them. Do you finance them by adding them to the loan amount? Do you take a slightly higher interest rate than you would otherwise qualify for so that the interest rate generates a credit to pay for those? Or maybe you just write a check. There isn't necessarily a right or wrong way to do it, but don't be so convinced that there's such thing as a free lunch. Thank you very much for watching. I'm Steve Doherty. I'm the Raleigh VA Loan Guy. I'll see you next time.